Have you ever heard of someone getting rich off the stock market? When this happens, it usually starts with the volatility of the stock. The buyer will buy in at a low price and sell it for a high profit. If you ever invested in stocks, you will see and feel the effects of volatility. Stock volatility is the rapid rise or fall of a stock's value, making the stock very unpredictable. I started investing when I turned 18 and dealt with the volatility of the stock market, especially during COVID when the market was doing very bad. First, I will talk about the cause and effect of a volatile stock market. Next, I will discuss how some people get rich off certain volatile stocks and risk factors involved. Finally, I will talk about certain long-term stocks that have low volatility. Stock volatility is the rapid rise or fall of a stock's value, making the stock very unpredictable. After doing some research, I am going to explain the cause and effects of a volatile stock market. According to Quepper 2021, volatility is statistically measure of the dispersion of returns for a given security or market index. So basically, a measure of how often a stock rises or falls. This can lead to either a positive or negative effect for the person investing, because if the stock has high volatility, then it is going to be constantly rising and falling. Now, if a stock has low volatility, it is most likely to be at a steady rate, either upward or downward. With that being said, this is where people can either make or lose money. Now what causes this, you may think? Well, according to Stobirsky 2018, many things influence stock market volatility, like politics, economic indicators, public relations, and disasters, and even volatility in other countries. Now that I have gone over cause and effects of a volatile stock market, I am now going to talk about how certain people use volatility to their advantage to make money and different risk factors involved. The risk and rewards in a volatile stock market. Many risks arise when dealing with a potential volatile stock. According to Wagner 2021, some key takeaways for stock market volatility is generally associated with investment risk. However, it may also be used to lock in superior returns, meaning that although it may be risky, there is potential for big money. Buying into a high volatile stock is risky because it can plummet at any time and leave the buyer out of a lot of money. The cause for this is usually a massive sell-off of that stock, causing the average price per share to tank. One example of a super volatile stock that's on the market is cryptocurrency. I am sure many of you have heard of Bitcoin, which is so volatile that it can rise thousands or fall thousands in a single day. Some people have the knowledge to predict this rise and fall trend and figure out how to buy and sell at just the right time. They call these people day traders. Day trading is extremely risky and only a small percent of people succeed. According to Mitchell 2020, less than 4.5% of day traders who try will be able to make a living from day trading. After talking about the risk and rewards of investing in volatile stocks, I am now going to shift into a safer long-term option with low volatility. Avoiding high volatile stock and sticking with a safer option. Although many stocks are very volatile, there is a good amount that aren't. These pose less of a threat of losing money. A good example of a stock with low volatility is the S&P 500, which is a stock that builds money over time with very little risk. According to Krantz 2021, if you're a long-term investor, any time is a good time to buy S&P 500 stock. Given how diversified it is, S&P 500 is the ultimate set it and forget it stock. Over long term, the S&P 500 has returned 9.9% a year on average since 1928. Today I have talked about how stock volatility is the rapid rise or fall of a stock's value, making the stock very unpredictable. Also, I have talked about the risk and rewards in a volatile stock market. Lastly, I talked about avoiding high volatile stocks and sticking with a safer option. Stock volatility is the rapid rise or fall of a stock's value, making the stock very unpredictable. In conclusion, high volatile stock is a risk to make fast money. On the other hand, a low volatile stock is a long-term, low-risk way to make money.